Good evening, everyone. Time for another silver update. This is the 30-minute chart of the US dollar Japanese yen provided by netdania.com. You can click on the link below. This is a trend that I noticed that developed over the weekend, and let me pull up the volume chart so you can see it. What I found very striking was that we had a massive run-up in the dollar yen, and then we had this big collapse on the weekend, all coinciding with the G20. Now you can see the volume there. It's really not matched by anything except for the volume that we had when we had the central bank intervention, which it did not. I called it central bank intervention when it started happening, when I saw us rounding down towards the 76 level. But it kind of happened in a very subtle fashion, but I think you can see these spikes in volume indicated that we had coordinated intervention. Then it came out later to be reported somewhere in here that yes, that the Bank of Japan had decided to print a whole bunch of money to just keep playing this game of competitive devaluation. So over the weekend we had this dramatic move on high volume, and the first chart that I posted, my speculation was that it was related to perhaps coordinated G20 intervention. Now, I've somewhat revised that opinion since I've recently come across this AIJ scandal that has broken in Japan, and I think that it may be related to that. So we're looking for a breakdown below this point here. So you can see that the length of the run that the yen has made against the dollar, we touched down to the 76 point. We rallied all the way up nearly to 82. We've collapsed back down to about 80, and we're looking to see where we can cross back into the 70s and see where this is going to go. On a longer term scale, you can see that the intervention that occurred with the Fukushima low here, if you remember back at that time when the Fukushima news first broke and I caught live the breakdown of this chart, it was my speculation that we would actually be moving very dramatically in this direction. And we in fact did. My speculation was based on the idea that rather than the yen weakening against the dollar, that the yen would probably strengthen on the speculation that Japan would be forced to sell off a lot of its treasuries, a lot of its foreign investments to raise cash to try to deal with that disaster. Now, right after that, we had coordinated central bank intervention. You can see the violence of that move. And then the next thing we had was the resumption of the natural trend until we had another central bank intervention, trend back down, another central bank intervention, and now we're trending back down off of that. So will we go into new lows? Will the yen actually get stronger and the dollar get weaker in the long run? I don't know. And does this AIJ thing have anything to do with it? And I'll talk about that when I cover that story. So let's jump over to the silver chart. Silver is very strong. Recently, we're trying to break out into this 35.50, 36 area. You can see that we have a very unusual formation here. This is sort of a, I won't even call this a pennant formation. It's more of a right angled 90-degree T formation or something, because it seems to just go just straight across here. And you can see it's correcting over time, so it's going to be meeting this price. The high right here is about 35.70. So if we punch through that, we're probably going to make the run at 36. And as I pointed out before, the choppiness that we have around the 36 through 39 area is going to present most of the resistance that we encounter going forward. So if you look in this area here, back during the consolidation after the May smackdown, we had quite a bit of trading between the 39 and 36 area. We also have an area up above us here that starts around 38 and runs to 44. That's going to be our next resistance point we need to get through to make a run at that $50 high. So there's really two areas of technical resistance that we're going to be facing as we get above that $36 price, 36 to 39 and 38 and 39 through 44. And that may take some time. Then again, it may be very rapid. It just depends on the strength of this run. Now we're very, very close to breaking out up above this 35.75. So I expect if we do get through that, we very easily could have a fairly strong punch right through the 36 and run fairly rapidly. You can see this, the speed that we came through this price range here. There's some resistance, but really a very little amount of time spent on it. We punched up through it, and we crashed down through it, and you can see very volatile movements in here. So we're looking for that movement through 36, and we may rally quickly to 38 if we get through that. On the gold chart, gold has a similar formation, not quite as strong as far as the flag, but gold has got this little level here right up above it that's roughly 1800, and that's just going to be 120 below the all-time high. So gold really doesn't have that far to run for it to make a run up into new highs. It could just continue and meander along and get there in a month or two, or it could move very rapidly. The last chart is going to be oil. Oil has kind of made a little bit of a top here. The old high is going to be up here at 115. That's going to be the price we're going to be shooting for, but you can see that we're starting to form a rounding formation. That may indicate, if you look at the MACD, it seems to be fairly well overbought and starting to roll over. But then again, when you look at a rise like we had here, you can see that we reached an overbought condition and another overbought condition, but we just kind of stayed at the high level. So it's quite possible for the MACD to just sit here and bump up against the ceiling as the price continues to rise. That happens fairly frequently. So let's jump over to one of the stories of the day, and that's going to be the AIJ fund. That is the fund that the news story broke over the weekend about AIJ, which is a hedge fund in Japan, and I wanted to jump into that story for a little bit here. AIJ Investment Advisors Company, suspended by Japan's financial regulator, told investors one of its funds returned 241% since it started in May 2002. Now I did some quick math on that. That comes to about 13% per year return. So what's interesting about that is, if you remember in the Madoff scandal, Madoff promised his investors roughly 10% return, but he actually ended up returning some say between 12 and 15%. So very close to the returns that Madoff was returning. And we're starting to see indications this may be a Madoff type of scheme. By mainly trading Nikkei 225 options, according to a newsletter obtained by Bloomberg. Now, that's very interesting, because if you know anything about the options game, you know that the options game, for the most part, is a zero-sum game. Now, obviously, you can have some kind of real growth in stocks, and people who participate in options can participate in that. You can imagine if someone had long-term calls, for example, say written on Apple, and they got the appreciation of that, took the shares. So, I mean, the options can participate in true growth, but by and large, for the most part, 95 to 99% of the winnings in options are the losses of someone else. So it's pretty much a zero-sum game. That means if these guys gained a couple $1 billion, somebody lost a couple $1 billion. And who were the losers if they were the winners? So the Financial Services Agency on February 24th ordered the Tokyo-based firm with 183.2 billion yen, 2.3 billion of client money, to stop business for a month as the regulator investigates possible losses to AIJ's funds. The return of AIJ's AIM Millennium Fund since inception compares with a 22% drop by the benchmark Topics Index and a 16% gain by the Nomura BPI benchmark for domestic bonds during the same period, according to a 4-page October 2011 newsletter in Japanese. alternative investment managers that eschew traditional investments such as stocks, bonds, and cash have come under scrutiny in the past 4 years since the collapse of hedge funds run by Bear Stearns Company in 2007. Bernie Madoff was arrested in 2008 for operating the largest Ponzi scheme in U.S. history, and hedge fund Galleon Group LLC co-founder Rajanam was found guilty in May. I don't, correct me if I'm wrong, but I thought Bear Stearns collapsed in 2008, so they might be wrong on that. Quote, the similarity in the Madoff situation and the AIJ situation is not necessarily the investment strategy, but the excessive degree of trust both fund managers inspired in people are similar to themselves, said Frank Picard, president of AAA Partners Japan, a Tokyo-based investment manager and advisor regarding hedge funds. The strategies of both firms seem to promise high returns. In fact, both appear to have been bogus. Okay, so, and I'll let you finish it yourself. I'll post a link to the article, but let's get to this key concept here of high returns. Now, what is a high return? How do you define what is a high return? Well, the SEC and I think the judge in the Madoff case stated that the returns that Madoff made year after year after year, consistent double-digit returns on a fund, was a smoking gun sort of thing to indicate fraud. I find that very amusing because we have hedge funds. I think we have, we have pension funds. I believe, correct me if I'm wrong, CalPERS is one that has projected year-over-year returns of 8%. So is CalPERS a Ponzi scheme? So it's very interesting to look at the fact that we have these governments. We have the Japanese government, the United States government, and increasingly we have the European governments who, at least the official rates, whose interest rates are approaching zero. And yet we have these retirement funds, pension funds, etc., that have promised these year-over-year returns. Note they never project a loss. They always project a gain. Year-over-year returns as high as 8% year after year after year after year. And of course, they're basing their projected payouts on these returns. So the question you'd have to ask is, if they're expecting these returns year after year after year, and they're required to invest in safe assets, safe being those declared safe by the rating agencies, which we've already explained are not really worth the paper they're written on. So what are they going to invest in? How are they going to achieve 6, 7, and 8% year-over-year returns when the only safe bets, which in my opinion aren't even safe themselves, sovereign debt, return 0.5%, 1%, way, way, way below the rate of inflation? It seems to me that the only way that any of these pension funds are actually going to make any money for their investors is to do what I think it was the state of Texas teachers retirement did by taking delivery of physical gold. I think Kyle Bass convinced them to do that. So obviously, if some of these funds fell over themselves racing to invest in physical silver, the first ones in the door would probably make 25% gains for the next 10 years. So it's obviously possible if you invest in the right things, but there's just not enough good investments to go around. And I wanted to use that to segue into the next article, and that's the idea that the way that you get returns on investment is by investing in free market investments where you have capital accumulation, which is savings that people actually use their savings and they loan it to ventures, business ventures that have potential for making productive investments and very sound business investments where they can actually get real returns on business. In other words, a real free market where you get real returns. That's not the environment we're operating in. The environment that we're operating in now is a fake environment. So if you look at this article that's featured on Zero Hedge by Jim Quinn of the Burning Platform, an excellent article. This is being talked about everywhere. This is called Extend and Pretend Coming to an End. So they have these projected investment returns. You can see this burned out, melted down, grown over, trashed out strip mall, which is, these are growing like blight all over the American landscape. And if you have this type of thing going on, then obviously the only thing you can do is extend and pretend about the way things are going to get better. I'm not going to read this because it's a very long article, but I did want to read some of it, and I wanted to point out some of the key charts in it. The first one being this Moody's Real Commercial Property Price Index chart. Now, what is fascinating about this chart is that you can see that prior to the latest the recent recession, which supposedly ended in the spring of 2009, you can see that we have not only come nowhere near our previous recessionary highs, but we actually really are still in a downtrend. So if you were to use this chart alone, you would have to say that the recession continues. If this is a recession that actually stretches from January 08, or actually December 2007, all the way to where we are right now, you'd have to admit that this is the longest recession in U.S. history, except barring the Great Depression, which perhaps we may be in the second Great Depression. So commercial real estate has simply not recovered, and what's so much more disturbing about that is that many of the loans are simply not being marked to market. So these loans are being carried on the books, and they're not worth even 50 cents on the dollar, but they're being carried on the bank's books at full value. You can see that the strip malls and the regional malls, they're spiking up to highs. You can look at the strip mall vacancy rate and see that even at the end of the recession, supposedly, the vacancy rate at the strip malls continued to rise, and now it's kind of hit a plateau where it just doesn't come down. Same sort of thing with the regional malls, although there's been a little dip. Nothing to indicate any kind of recovery on that. Now, the one thing I wanted to point out about this, and the other thing before I go to that, is retail sales. You can see retail sales have gone into new highs. And you have to remember that these are in billions of dollars, so you're going to have to do some inflation adjustment. So we might actually not be in new highs. But one key thing to point out here with retail sales is if you look at the last recession, you can see you had a big jump and then a fall back, and then we pushed out of the recession, but we actually exited the recession at a higher rate in retail sales than we entered the recession. Same thing with the ex-gasoline index. But if you look at the current index, you can see that when we supposedly exited the recession, it actually took us a full year and a half to reach the same highs we had prior to the recession. So not as weak as the other indicators, but very weak. Total revolving credit is continuously falling. You can see it's fallen even more significantly since the end of the recession than it did from the beginning to the end. But the thing I really wanted to point out here is very key to this extend and pretend sort of thing. He goes through and he details these stores here. You've got Home Depot, you've got Target, JCPenney, Sears, Kmart, Best Buy, and the Lowe's. And the thing that's very interesting about this indicator that he points out here, he goes through and talks about the net income, the revenues, and you have to deal with the fact that they build more stores and they have all this adjustment to their numbers. But if you want to break that all down and just get to the root of it, it's real simple if you just use this sales per square foot figure, because that's a figure that they're not going to be able to lie about. They're not going to be able to build a whole bunch of more stores and say their revenues are different, or close a whole bunch of stores. You're just going to look at the square foot of store space they have and what the revenues they have. And you can see for Home Depot, sales per square foot have declined from $335 to $296, 12% decline in 4 years. For Target, sales per square foot have declined $307 to $280 since 2007. JCPenney sales per square foot have plunged by 14% since 2007. Sears Kmart, excuse me, sales per square foot is down 15%. Best Buy, sales per square foot has decreased 13%. And last of all, Lowe's, sales per square foot has declined 21% over the last 4 years. So just like the unemployment figures, the way you cut through the facts of the unemployment figures, it's really very simple. You just look at what are the tax revenues of the various governments. That is going to be a true figure. If those tax revenues are continuing to decline based on income tax, then you know that the situation is not getting better. It's in fact getting worse. And the same thing with these sales per square foot. So we don't have real markets. We don't have real investments. We don't have real numbers. We have what I will term one gigantic global Ponzi scheme where everybody is expecting to retire. Everybody's assuming these great returns, but they're simply not there. So, the last thing I want to take you over to is the blog, and that's because if you missed the last one I did, I have added a forum. You can just go to the blog, click on forum, and it will take you to it. It's currently set to the MyBB, and I'm going to change that. But I just wanted to show you how we've added some themes. If you're logged in and you go to your user control panel, you can go over to edit your options, and there's a number of themes that you can use for the style. So currently there's the IVGEO, the Cure, and the V Bulletin. I happen to like the Cure right now, but you can see if you do that, it changes the style, and we'll go back to the main board, and you can see how it customizes it. So it kind of changes the view. You have control of the view yourself. You can set that. So I encourage everybody to go ahead and sign up and post on the forum. And if you haven't joined the contest or sweepstakes, go ahead and do that too. So back to the main chart is the first one I talked about. We're going to watch the yen dollar very carefully. It seems to me that we have put in a very serious top, and I think we're going to do something like this. And that's going to probably be caused by the AIJ scandal, and it may end up in a very much lower dollar. Of course, that may end up with a very much higher silver price if the dollar begins to weaken significantly. So 36 is the next target we're looking for, and we're looking for how we do between that 36 and 39 range. And we'll talk to you next time.